The time to get a loan is when the sun is shining and things are good, because that's when the banks are going to be most aggressive. That's when you put a bid package together and you're going to get competition, and that competition is going to drive a market price. When you're in a pinch, they know it. And so the pricing and the structure is going to reflect that. And my biggest tip relative to banking partners is have great relationships with your banks. When it comes time to put the deal out, you got to bid it out. You got to get the best deal. You're a fiduciary of the company. But once the business is closed, then you have to be in the business of building the relationship. You need to shower those banks with cross-sell revenue and incremental, the guys that lend you the money, when you need them. So move your credit card business over to the bank, because in a pinch, having worked on that side of the fence for many years, that's what those guys are looking at. They're looking at incremental wallet share. And if they have a big wallet share like our lead banks do, they're going to help you during those softer times, because they know if you're a good business, you'll come out the other side, and they want to retain all that cross sell.
Is this thing on?
Yesterday's price is not today's price.
Hey everybody, welcome back to Run the Numbers, where I break down business models and do lots of cool CFO stuff. That's my dog, Walter. I just did an interview with Philip Brenckle, the CFO of West Shore Home, and a lot of you out there have probably done a home remodel in the past, and it was probably miserable. Yeah, not a lot of A+ ratings on those going around. Phil is the CFO of West Shore Home, and they are revolutionizing the way that people go about remodeling their house. People spend a lot of money on it, and he explains their business, how it has a large direct-to-consumer component, what percentage of home remodels are financed using credit, the average split between labor and materials. We go deep. Walter, not right now. I'm not remodeling your home. Phil walks us through the financing decisions that go into doing home remodels and how his company is changing the way that people buy it. The verticalization of industries like home remodeling is going on everywhere, and there's a lot of money out there. Private equity is chomping at the bit. Phil also talks about how M&A is part of their strategy and how to work with great advisors. Sometimes you do actually want to pay a little bit more to those lawyers and bankers. Phil also has some pretty cool frameworks or mental models that he uses in his work, and he leverages his background in commercial banking before making the leap to CFO. There are probably some people out there right now who do have some sort of commercial banking background, and they're thinking, how do I become an operator? Well, you'll learn on this podcast. All this and much, much more after a short word from our sponsors. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Philip, welcome to the Run the Numbers podcast.
Hey, thanks, CJ. Good morning.
All right, before we jump into the meat and potatoes of today's podcast, what's the sign behind you say? Does that say you can't deposit excuses?
You are correct. That is exactly what it says, which is, I guess, very fitting for the chief financial officer of a company because excuses don't make it to the bank and they don't generate cash flow.
I need to get that from my office. So like when people come to me with a request or they come to me with an excuse, better yet, I can just point to it behind me.
Exactly. Yeah, I pointed to it more than once. Someone sitting across from me in this office.
So I want to talk about West Shore Home, and then we'll get into kind of your philosophies being a CFO. And we were talking about before the pod started, some of the best ones that we do here are when you talk to a leader who's not from B2B SaaS world, where a lot of listeners are. What I think is so cool about your model is that West Shore Home is involved in remodeling homes, which I think everybody can relate to. I actually just became a new homeowner, and I'm sure there's going to be some remodeling done there. For the people listening, can you explain why changing the home remodeling experience is important? So like, why is it broken today?
We believe it is actually kind of the final frontier, meaning it is one of the largest TAMs in the United States that has not really had a lot of change to it, meaning the way it's been done is the way it's been done. And, Harvard estimates this TAM, repair and remodel, to be roughly $500 billion. So it's a massive market. And I think all that people have to do is think back to their last home remodeling project. Generally, it was sort of a headache at worst. It was a nightmare at best. Right. And the problems, there's just problems fraught throughout the entire process, from getting the communication, getting the contractor to come out, getting a price, the price changes during the project, contractors in the house forever. It seems like there's dust everywhere. It's dirty and everybody loves to improve their house. They just hate the process of getting to the improvement. And that's really one of the theses behind West Shore. Is if we could make that process better using technology, using W-2 labor, using, a bunch of different things that we've come up with to make that experience more pleasurable for the homeowner, it would grow the overall TAM, because I think a lot of people don't remodel, not because they don't have the means. It's more they don't have the time and they don't want to deal with the headache. As soon as they finish a home remodeling project, they need a break before they kind of start their next one, because it's a painful process. So, that's something our founder really honed in on when he started to grow and scale the business, is kind of shifting the business more towards this idea of our line has always been making home improvement fast, easy, and convenient, right? Which kind of is counterintuitive to what you know about home improvement. So I really do. I believe we're solving a very important problem. I also just recently moved locations and have dealt with a number of different contractors, because we're only in a couple of spaces right now. That'll change over time, but had to use non-West Shore Home to accomplish some things. And I lived and breathed all of the things I just talked about. And they're all good intentioned people. It's just they're often, they lack scale, they lack sophistication, they lack systems, they lack infrastructure. And, that just makes it really hard to deliver a Amazon experience when you're dealing with kind of local mom and pops. And so that's really where we want to attack the market and really grow to be that solution where people sort of, today they say grab an Uber, right? Maybe someday they'll say something like, just call West Shore, just click the West Shore button and you can get the home improvement service. And what a differentiated experience that would be.
I love what you're doing because it's kind of like you're making the pie bigger, and a lot of times you called it the last frontier. It's so applicable because a lot of times you'll see things that move from pen and paper to online, and the critics will say, "Oh, you're just hijacking the revenue that was already there as it comes on board." But it sounds like to me, like Uber, you're actually making the TAM bigger.
That's exactly right. Today we aren't fully available to sell our products online, but that is something that has been in the works. because really what our goal here is to deliver that omni-channel experience, right? We want to meet customers where they want to be met. I'm looking at some blinds and look, maybe I want to touch, feel the product. There's some online blind companies that just sell online. And I decided to finally walk in and go into a showroom and talk with somebody because I just felt like I needed to see the product, touch the product. So there's always going to be those customers that want to have somebody help guide them in the process. But we believe there's going to be a fast growing population, and the data supports it because the do it for me economy is growing much faster than the do it yourself economy, that they're going to want the DIFM, but more importantly, they want to limit their interactions with humans. Generally, this is a younger population where, they would prefer to do things over the internet. I mean, Tesla is a great example. Most people buy their Tesla over the internet without ever really talking to a car dealer. And I'm sure when that concept was, brought out, everyone probably thought Elon was crazy. Like, you're not going to go down to the lot and negotiate the sale. CarMax is probably a great example more of where we're going to be, which is to provide that experience across the entire shopper spectrum and not just, at the car lot, kind of everything in between. It could be a virtual consultation. It could be completely online, or it could be totally in the home, kind of whatever the customer wants.
I really like how you said you have to meet the customer where they want to transact. It's so true. You can't stay, just on one channel. If the customer, like you said, some do want to come in and see it, touch it, feel it. Others just want to buy it online. I had a friend, and I never thought this would happen, but like he bought a house on sight unseen online without even going to it. And he's a normal dude. Like he's my buddy. Shout out Mike Brez. But like before you have a friend that's actually done that or someone it doesn't feel like a real option. But to your point, some people do want to just buy something online.
Yeah, no. And I mean, again, we're getting there. We're not there yet. Our model is kind of the model that everyone's using right now. Although I think we really revolutionized kind of what I would say the 1-day installation. That was kind of the first thing that we brought to the market at scale, where we remodel bathrooms in just 1 day. Now that was generally the wet space in the shower. We've subsequently added other parts of the bathroom, but even those jobs generally take as little as like 2 or 3 days. Wow. So when you look at a really, relatively quick turn time, and we use all of our own employee installers, so it's all W-2. So if there are any problems in that process, you're going to deal with West Shore in terms of, having somebody troubleshoot that for you. So it's probably a lot less risky to buy your bathroom online as it is to buy your house online. But you're exactly right. I think these larger ticket purchases, there's a lot of people that have come before us that have shown that you can transact and grow the total addressable market for large ticket items online versus, the sort of the traditional way e-commerce got started, which was smaller dollar figures.
Philip, you have a large direct-to-consumer portion of your company. This is going to sound really stupid to listeners. What does direct-to-consumer mean? What are you replacing?
Yeah, so it's all direct-to-consumer. Our business doesn't do contractor sales. We don't even do like multifamily where we would sell to like a developer or something like that. It's all direct-to-consumer. So this is a consumer inquiring with us. We send somebody out to the home with all the materials, design it. It's windows, full baths, and doors are the 3 main categories today. But there's a portfolio we can talk about here later in terms of how we expand that pie. Very much use the Amazon model. We wanted to scale nationwide. So if you offer 25 different products, it's really hard to scale something when it's too complex. And I mean, that's obviously what Bezos did with using books as the basis to scale Amazon. Very similar story with us. But at the end of the day, we're going to come out to your house and we're going to give you a price to remodel one of those 3 product categories. And then, shortly thereafter, we're going to have a crew of our employees come out and install that product. And, generally the average product is going to take somewhere between 1 and 3 days to complete that entire installation. So just kind of making that process, again, back to that very fast, easy, and convenient.
I like how you said you almost hone in on like your white hot center. Like I'm just making it up. Like we're going to do bathroom remodelings or shower remodelings, even to be like hyper specific first. And then from there, you expand over time. But just like Bezos with books, you have to do that part right. And then you can go after the long tail around it, which expands your TAM.
Yeah, it's really what I think is the special sauce to our business. This business was created in 2006 as a small home improvement company, just like every other home improvement company all around the nation. And then our founder, after a few years, he was just a regular home improvement company for the first few years. And then he started to see the vision and the opportunity to say, he was asking himself that question of like, why are there no national home remodeling brands, right? Like, in the sense, obviously there's Lowe's and Depot, but those are retailers that sell. Like, why isn't there actually like an installed services national brand that everyone just thinks of? And the more he studied it, and looked at the reasons why, actually Harvard wrote a white paper on this, I think in like 2014 or 2013. And it just, one of the things it talked about was complexity, that often contractors do a bunch of different things, which makes scaling really difficult. So that's kind of why he said, like, I'm going to keep the product set narrow, and then I'm going to build the platform and the technology and all the things that kind of run the business before I scale the business, as opposed to often what happens is people see an opportunity, or maybe it's a, private equity roll up or something like that, where you're kind of scaling
Right.
as you go. We kind of built the foundation of our business before we set on a path to scale. Distribution is a great example, using Amazon. Today we have like I think it's a little over 1.3 million of warehousing strategically located all throughout the United States. We have distribution centers that feed stock all throughout the United States. We didn't have anything like that 5 or 6 years ago. So we've really built a lot of the infrastructure. I think that Bezos and Amazon examples is very similar in terms of like really focusing in on getting the distribution and the model right before you add 15 products and become, 10 billion in sales.
An interesting wrinkle here, and there are a lot of finance people who love to just dig into business models and nerd out on this stuff. And probably some people are listening to this right now and thinking, do you know what percentage of home remodels are credit financed?
I can tell you that for our business.
Yeah.
I can't speak for the broader economy. Usually it vacillates somewhere between 70 and 75%. But that number
that's a high amount.
It is that, well, there's two reasons for that. First of all, there's, this industry has formed and grown over the past 10 years. There's an unsecured product that we offer. So kind of that idea of not having to go through the home equity process, which is another process that's
you beat me to my next question, man. Yeah,
time, energy, exactly. So that industry has grown rapidly. There are several really large companies, including Wells Fargo, one of the bigger ones, Green Sky. There's some really big finance companies out there. So let's take that 70% and break it down a little bit further. In our business, just like a lot of consumer businesses, we run a lot of promotion. And so some of our promotion kind of amounts to what is like sort of a same as cash deal. So a lot of people will say, well, hey, I want to pay cash. And then they'll see our promotion and they'll be like, well, if it's going to be your money instead of mine, like, I'll take advantage of your promotion. So approximately 30 to 40% of our business is promotion, where it's likely the homeowner may have had the money to pay for the product. And then obviously the remaining delta is those people that want to use the term financing to make the monthly payment, because they may have some money to put down, but a large project can be as much as $25,000, $30,000. We actually had I think yesterday we had our largest one-day sale record, where we sold a homeowner over $140,000 worth of products in the window bath door space. I think they had a couple things they wanted to get.
A lot of bathrooms.
Stuff. Exactly. So, the price can go as high as 140 and probably as small as, a few $1,000s. So, depending on the size of the project, again, people may put it down, but we have 100% finance options where, people they can take out a 10-year or even in a 15-year, but 10 is probably the most common. Somewhere between 7 and 10 is usually the most common, and take out a 7 or 10-year term loan and make that low monthly payment.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. What does the future hold for business? Can someone invent a crystal ball? Until then, over 38,000 businesses, that's a lot of companies, have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, and HR into one platform. With real-time insights and forecasting, you're able to peer into the future and seize new opportunities. Download the CFO's Guide to AI and Machine Learning for free at netsuite.com/metrics. That's netsuite.com/metrics. METRICS, metrics. Please, guys, I really need this. So me and my wife just bought a couch. By the way, couches, they must be like made of gold. I don't know why they're so expensive. But
Amen to that.
And I was about to pay for it. And then they were like, do you want, like, basically for, I think it was 12 months, you pay them like nothing. And I was like, well,
no interest,
I was going to pay
payments.
for it, but like your money's better than mine. How does that work? Like, it sounds like you have something similar. So are you using like credit on your end to finance their purchase essentially?
As a matter of fact, it could even be the same underlying vendors, because a lot of the vendors that are in our space may have exposure to furniture as well. Green Sky is I think they may be the largest. They don't publish a lot of statistics because like Wells, this is just a small sliver of their business. So you can't really see what's actually going on compared to Wells. But we'll use Green Sky because they were sort of the ones that really came on first with the apps, the in-home apps and the online applications. I think they originate, $6-7 billion a year in this paper. What we have is a tech platform that facilitates the sale of those loans to those providers. So we're not actually holding any of the credit risk. We're making a point of sale financing offer. And so that's exactly what happened in that furniture store. You were given probably an application with a Wells or a Synchrony, or Synchrony's pretty big in the furniture space.
I think that's who it was actually.
Yeah, they're really big in the furniture space. So you put in an application directly with Synchrony, and then Synchrony immediately bought that loan, and the furniture store was just the facilitator. So we use a very similar technology, but we've actually built it to be more of like a lending tree model so that customers have multiple options, because these purchases sometimes are large in nature. We figure, again, consumer choice, meeting the consumer where they want to be met. These are the things that, that the Amazons of the world make that great consumer experience. We want to have that similar experience in our business.
Nothing gets my father hyped up more than buying like a 60-inch TV at Best Buy and being like, I don't have to pay for it for 2 years. And like the guy could pay for it, but like he just enjoys the feeling that they're giving him this deal that he can take.
It's promotion, right? It's the good old promotion. Powers the U.S. consumer economy.
Yeah, it keeps it rolling. It lubricates the economy. On the other portion, so a percentage, I think you said 30% is promotion. The other financed chunks of it, I wrote about this recently, that vertical software companies, or just companies that serve a space specifically like yours with home improvement, should you add a payments module? Should you add a financing module? How did you go about that? Did you just look at it and say, listen, we're highly qualified in the position we sit within the ecosystem to offer financing, and it allows us to double up, or is it something that costs you money and it just kind of, like we said, it increases the velocity of deals?
It does cost money.
It does. Okay.
It's not like cars. I'm sure back in the day, car loans actually used to cost the dealers money, but then the banks realized what a great market this was, and then they started paying dealers to originate the paper for them. And now that's a huge business. Our industry's not there yet. Not to mention, we do have the promotional offers. So, when Chevrolet offers you 1% interest for 60 months, Chevy is probably subsidizing that product. But if you're just offering a regular, say you get a 9.9 10-year unsecured loan with us, the cost for that aren't terribly high, but there is cost to it. But to kind of get back to I think what is your core question? Our founder was always on the cutting edge of technology. So he was using consumer financing when he first started the business, using fax machines. And phone numbers. That's how it was done. And he was a very early adopter when Green Sky sort of came onto the scene and started offering like iPads that you could do this. And then, he grew that business pretty well. And then when I joined the firm back in 2020, I really saw an opportunity to, given our growing size and scale, to work with multiple lenders, to get different programs, to kind of have a suite of services so that the customer was empowered. So we set in partnership with a technology vendor to design something that would kind of create that, just like a lending tree for a mortgage. It would offer kind of a very similar opportunity for the customer to have lots of choices, see what the promotion offer is, see what the payment terms are. And, these things are credit scored in the sense that obviously you get better terms, the higher quality your credit and the, related metrics are. So, one customer could qualify for a 699 and another customer might only qualify for a 1099. So we wanted to make sure that we had the most optionality out there to again, make credit available. And I think it's really helped transform home improvement as this point of sale financing. I'm sure the finance companies will love this plug, but the bottom line is you move more product when you offer financing, and you can break a larger purchase down to a payment. And obviously, if you factor in an unsecured nature of it so that there's not liens and mortgages and things like that, and make the process simple, it facilitates sales. So, the bottom line is it is a very important part of our business.
Yeah, these consumer lending options are everywhere now. It's not just for big purchases. I bought a pair of running shoes the other day, and they're like, "Do you want to make 4 payments of $50?"
Yep.
And it doesn't cost the consumer much either.
Exactly. Yep. It's a promotion thing, meaning, that, if it's on running or somebody like that, like they paid a few extra dollars to allow you to just pay, 4 payments of $50, and they got a sale, and they are getting more sales because someone says, well, geez, if I can break it down to $50 for 2 or 3 months, I'll go ahead and buy those shoes right now, especially if I'm not paying interest. So there's a prime example of where, that sale is going to get fueled. And that's why you've seen, the Amazon platforms and things like that. They have these flex payment plans that really, I know, are helping drive sales. And it's the same thing in the big ticket world. I use that great example. Can you imagine going to the car lot today and they're like, yeah, we don't have financing. You have to pay cash for this thing, right? Like that's kind of what home improvement guys were doing. They're walking into people's houses and saying, give me $25,000 to fix this, but unless you have a home equity or cash, I can't really help you. So it really has been a big part. It's, it's not, there's other ways to do what we're doing here, but at the end of the day, it really is a very important part of what we do.
It is interesting how it swung, specifically within the car market, because they used to make the most off the actual cars. Now they make the most margin off the F&I. And from the outside, I think a lot of companies look at it like, oh, wow, we could actually make more if we added financing to this. But you actually have to step back and think, well, what's the average take rate you can get for your industry? So Tidemark, their VC firm that specializes in vertical software and SMBs, they did this study of what's the average take rate that you can get across different sectors. And I think it was 80 basis points was the median, but some are less and some are more. And to your point, you actually may lose money on the financing, and companies need to look into that. But as a result, is the net present value of getting more sales worth it over time?
That is the numbers we've run, and we can tell you, at least in our business, the answer is yes. So again, the consumer finance guys are going to love the commercial I'm doing for them, but yeah, the answer is yes. Consumer finance makes a difference.
Philip, what's the average split between labor and materials? Because it sounds like you're well situated to sell like the whole thing. You were saying that the employees are they W-2 employees who install it?
Yes. Yep. We use all W-2 employees across our whole value chain. Anything that touches the customer, we want a West Shore home employee to be involved in that. So that could be calling into the contact center to set an appointment, to schedule the appointment once the sale is made, customer service, like you name it, including the installer who comes out. Those are all our W-2 employees, which again is kind of counterintuitive to the industry. The industry is built on subcontractors. So the biggest names in home remodeling, if you will, because of their installed services, are probably Lowe's and Depot. Sears used to be quite large. I think they're considerably smaller now in the home services space, but they were retailers that said, "Look, let's just hire subcontractors, and we'll kind of sell it out of the store as a revenue generation opportunity." And that's been the norm of the industry. Even the small mom and pop businesses will often employ subcontractors to do the work because they think the liability savings, the insurance, they're obviously risk adverse. And we realized if we were going to build a brand and really put quality behind it, BJ, our founder, actually kind of figured that out in the first year because he said, "Phil, I spent more time chasing around the challenges that were generated from the subcontractors versus actually selling." And that's when I realized, like, I need to hire my own employees where I can set their work hours. I'll give them vacation and benefits and things like that. But, I have to control quality at the source because this is the experience with the customer. The final thumbs up or thumbs down comes when that installer walks in the house and does the project. And if it goes great, that customer feels like they're on HGTV. If it goes bad, they're going to be on the internet telling everybody about it. So, that's something that we've sort of made a rule is we have to have our own labor to control quality at the source.
And so then do you make a margin on both the labor as a HQ or company and on the parts?
We do, and I apologize I didn't answer your question.
No worries.
It's about, when you're talking gross margin, it's about 60% materials, 40% labor. And to your point, like, we just look at that gross margin, and then we look at our marketing expense and our G&A, and that's how we figure out our markup. So yeah, you're, in the true business model sense, you're getting a markup on your labor as well as on your materials.
Is that called a cost plus model?
I know what you're saying. That's more common in what I would call commercial construction, where it's sort of like an open book, where you say, "Hey, these are our costs, and then we're going to mark them up 20%."
We have it in the auto industry. Like if you go to a mechanic, that's what they usually do.
Yes, yeah. In our industry, it's more bundled. It's sort of like, hey, the price to install the window is whatever, $700 a window, and that's the price. But the guy next to you, well, obviously, we're going to fight to win that sale and say, but the guy next to you is going to send a subcontractor out who, may not be drug tested, may have a criminal background, may, not care about the quality of his work because he's not even an employee of the company, right? So that's a big selling point for us when dealing with consumers is these are our employees. So if they do a bunch of bad installs, they don't work here anymore. And we criminal background check and drug test and all those other things because, again, we're sending people into people's homes. It's their most intimate possession, if not their most valuable.
Yeah, it's a great takeaway for people listening, especially CFOs who are evaluating, should we try to cut some corners here and save some money around contractors? It's like, no, when people zig, you should zag sometimes and actually pay more because you're going to get higher quality out of it, which gets the flywheel going to get more customers.
That's exactly right. And also, you'll appreciate this one going back to the COVID days. It was actually a huge advantage for us to have our own labor because there was sort of this, bizarre shift where obviously all of a sudden the subcontractors kind of owned the operators that they were working for because there was so much demand for installation services. The demand for their business shot up. So now you probably, we don't do subcontractors, but I would imagine you have a pretty weird dynamic where now as the market's normalized a little bit, it's like, well, you were paying extra because there was so much demand. Now you got to go back to that subcontractor and say, hey, we're not paying you that rate anymore. For us, it's wages, right? And I mean, during the height of COVID, we did some bonuses and things like that, just because, again, there was a lot of people attacking our labor. But, we were able to really navigate that situation. Again, I can't even imagine what it would be like managing tons of subcontractors who all had a million different home improvement companies reaching out to them and saying, what do I have to pay you to come over and work for me? And now all of a sudden that, that pendulum swung the other way. And I mean, there's still plenty of demand, and we could talk about that because I think the home improvement economy is very interesting right now. There's a lot going on, but the punchline up front is the long-term economics of this market look extremely positive because there's a lot of things work in our favor, despite all the economic noise around higher interest rates and a pending recession and things like that. There are just too many factors working in home improvement's favor for this industry to not continue to thrive over the next 10 years.
It's funny because my father-in-law, he has a hardwood floor business, and during COVID, he could quote anything and people would say, yes, we'll take it. How do you come up with the prices internally, Philip, based on like macro cycles? Does stuff change? Like labor can go up, parts, the materials can go up. How do you know what to price it competitively at?
Yeah, I mean, there's a lot that goes into it. Again, we have technology, which is awesome. So our price is our price in the sense that the individual sales rep cannot change the price too much. Because the technology programs it, like if you want this done, it costs X. So that way, whenever our employees are dispatched to go talk to a customer, they are going to be giving the same price if you're in. Now, there might be some minor adjustments for a city. So for instance, the cost of construction in Colorado might be higher than the cost of construction in Ocala, Florida. But those would be minor tweaks, as opposed to if you have no system, one sales rep could be out there being like, well, I want to really discount everything really low. And another one's like, well, I'm trying to maximize my commission, so I'm going to charge like even more. Our system is set up so that the price is the price. Everyone gets the same price. Obviously, we offer promotional discountings and initial visit discounts and things like that. But it's very similar across the board. So, how we attack the pricing is a combination of evaluating the market, right, where our others are at. We kind of trying to be somewhere in the middle of the market. We don't want to be the absolute highest cost vendor out there, but by every stretch of the imagination, we are certainly not trying to chase the bottom vendors, which are very common in our industry because the barriers to entry, I always say the barriers to entry in this business are nothing. The barriers to scale are quite different, right? It takes capital, it takes systems, it takes infrastructure to scale, but to get into the business, right, you need a truck. I mean, we have millions and millions of dollars of overhead that has to be factored into our pricing. But manufacturers also play a role in pricing. We buy our products white label, but a lot of the products that we buy white label are sold branded somewhere else, which is a lot of things in the United States that, the Reebok, and I don't know this factually, but the Reebok and the Nike sneakers probably don't get made in all that different factories. They just have different logos on them. It's kind of the same thing in building products. So those manufacturers set pricing standards as well to make sure that you don't have people on each ends of the spectrum, right? You have guys way undercutting pricing for their large dealers, and then conversely, the opposite side is making sure that they're not price gouging consumers. So it's kind of a combination of the market, looking at our own internal financials, and then kind of also looking what the manufacturers are kind of suggesting from an MSRP perspective.
Yeah, you kind of triangulate it based on that. Hey,
Exactly.
Philip, sometimes I'm like a dog with a bone when I hear something. You had pointed out like the ability to start versus stay. They're two different skill sets. Has M&A been going on within your industry? What consolidation? What's going on there?
Yeah, we aren't the only ones that figured out this was the final frontier of an unconsolidated industry and a $500 billion TAM.
Yeah, it sounds pretty juicy.
Yeah, there's been a fair amount of consolidation. I tend to look at things that are more applicable to our verticals, but there's been things like HVAC and roofing and things. I mean, there are some really, really large companies out there that are in those verticals. And 6, 7, 8 years ago, the largest home improvement company was, don't quote me on this, but probably somewhere around 100 million in sales. There is a competitor business of ours that's in the leaf business, and I think they had actually scaled a little bit larger, but they were more of a products company back then than a home improvement company. You're talking swinging hammers, doing multiple trades. There were very few small operators. Fast forward, there are several companies that are at $1 billion or over $1 billion in sales now. And a lot of that has come through consolidation. Some of it's been organic, but a lot of that has come through roll-ups. And there's a ton of them out there. So there's been, just within our industry, there's 4 or 5 companies that didn't exist 5 years ago, and they're now 600 or 700 million plus in sales. And those companies, pretty much got there overnight through M&A. From our side, we have participated in M&A as well. We have tended to do it at a smaller scale in the sense that we didn't buy any of the really large, what I would call regional operators. We focused more on, someone that had 1, 2, or 3 locations, maybe was somewhere between 5 and 20 million in sales, and kind of more bolted them on because we have a pretty good growth platform. So it made sense to buy a smaller company where the EBITDA multiple was X and grow it using our infrastructure to a much larger company where the multiple is obviously, much higher. So that's really been kind of our strategy. We've done 9 deals. I think the total revenue of those 9 deals is a little less than $100 million, but we've grown that $100 million probably 4 to 5x that. And then all the other growth has been organic. M&A has quieted down as interest rates have, kind of surged, and there had to be kind of a reset between buyers and sellers on exactly where the fair multiple was. We, though, have actually started to get very active here in the past 6 months. We've looked at a number of packages, and I think we'll probably do some deals in the next kind of 12 to 18 months.
Are most of the deals that you're doing buying family-owned businesses who, are looking for some sort of exit?
Yep. They're all, same sort of thing. There's a lot of people in the age bracket of 50 to 70 years old in this industry that were in it for 20 or 30 years. And, they're looking for a contingency plan. Again, to show you how far we've come. The first few acquisitions that BJ did were very novel in the sense that like no one had ever done it. And a lot of these owners were kind of like, well, I'm either going to sell it to you, or if they were older, like I might just close it down and just collect all the capital. And, I can get a pretty good payday. I got a lot of money in the bank and things like that. So like, that's how they thought about those businesses. And now as this industry has grown, these businesses trade just like other businesses in the sense that we kind of made a market here, at least in the window, door, and bath space. And then, there were other pioneers in roofing and HVAC. The Wrench Group, I know, is, I think, one of the largest in HVAC. And they were probably one of the pioneers that really got after it and rolling up all these, local mom and pop HVAC providers and putting them into a really, really large platform.
It is wild, though, that there is this whole generation of people within that age bracket. And say you do HVAC or you're a car mechanic. If your son doesn't want to be a car mechanic, you're like, I guess I'll just shut it down in 2 years.
Yep. You still see it today, whether it's, retail stores or things like that, where, they're just the market's not there for that small business. So it's been we've been a great thing for people in our industry to create liquidity, to create a marketplace, and to offer an exit strategy. And that's exactly what we did. We worked with, 9 separate founders who were in a position. Some were older. Some just wanted out of home improvement. They'd been in it for 20 years and they weren't that old, but they wanted to kind of go on to their next thing. They had another business idea and they wanted to, get into real estate or get into, something else. And they wanted to exit the business. So we're kind of like a blackjack table. We're always open for business when it comes to M&A.
I love that. If you thought about like a M&A deal as like a deal in a box, are there any structures that are typical to rely upon?
So, again, mentioned, private equity made a big push into this space.
Yeah.
We function much more like a strategic buyer. And that's, that is sort of if you put that classic, like if you were going to sell your business, sat down with your investment banker and said, all right, here's what the strategic's going to want. Here's what the private equity is going to want. We're going to act more like that strategic. So we offer a turnkey sale. You just flip us the keys, and that's actually what we want. The owner can transition if he wants, but generally we found that most of these owners, they kind of want to transition at first, and then they're like, yeah, no, I got my money. So we kind of offer that opportunity of like, sell us 100% of the business, cash everything out at closing, get all your money, like just kind of be done with it and ride off into the sunset, versus the private equity guys are more looking for that, rolled equity, earnout structure. You stay on in the business and operate it. And, there are probably varying degrees of satisfaction with those that chose that model in terms of, what it's like. Because remember, these are small entrepreneurs. They now have a boss, right? And that's what we always try to explain to them. Like, that model generally doesn't work well. When you work for yourself for 30 years and all of a sudden you have a boss, it does sometimes create. So that's our offering to owners, is to say, look, just throw us the keys and we have the operating model. We'll change the name. Sometimes they like that, sometimes they don't. I always try to explain to them, like, look, if you get to keep your brand, but you don't own the brand anymore, what if it turns into something that you don't like? And everyone still associates you, because oftentimes the name of the founder is in the brand.
Yeah.
And so it's like, do you really want that? So, maybe changing the brand over to West Shore isn't such a bad idea, because then everyone's clear that you sold to West Shore. So we're going to function much more like a strategic buyer, where, we're just doing, for the most part, there could be a delayed note or something like that. But on the margin, these are all 100% cash at closing. Get your money and flip us the keys.
Yeah, that's a clean deal right there. Some of the earnouts with the private equity companies can be, they can almost feel like indentured servitude.
Yeah, well, and you usually have rollover equity too. So you're waiting on your earnout, then you got to wait for an event to get the quote unquote second bite of the apple. And so we just try to make it easy for owners to say, look, what do you think the business is worth? And let's give you that number right now up front, and you go do your other thing, and hopefully we're going to grow your business, 3 or 4 fold, and employ more people in the local economy, and all that good stuff. And that's been how it's gone. So it's been a very good story that's, I think, resonated with a lot of people that have sold to us. They're sort of happy with their outcomes versus, maybe staying there and working for somebody else after being entrepreneurs, most of their whole lives.
Hey, Philip, I heard you say that you shouldn't cut corners on great advisors. Can you unpack that for us?
Look, this is something, I came from a banking background. So that's, this is actually my first stop as a CFO, potentially my only, if you will. I'm very close with our founder, and it's been an amazing story. But I was in corporate banking for many years prior to becoming a CFO. My first day was COVID. We shut the business down as my first day as a CFO. So yeah, welcome to the company. But being quote unquote an advisor definitely gave me appreciation. But particularly as I navigated some of the things, like we did do an equity offering and sold 20% of the business. Obviously, we raised large debt facilities. We've done a lot of capital related. We work very closely with investment bankers. So I've had the experience of dealing with all kinds of advisors. And, this is just not an area that you want to cut corners on. I mean, whether it's, we use a Big Four accounting firm, we don't ever want to have anyone question our financial statements, right? That is in some ways the value of the business is the financial statements, right? That's how you prove your value. So we've always tried to really hire high-end advisors, and they're never cheap. But I can cite numerous examples as I've gone through deals where I'm like, okay, that just paid for itself, right? And so I'm a big believer. And even on the other side, when we're selling a business, I almost beg, or buy a business, I almost beg the buyer to go get the most competent M&A attorney in town, because it actually makes our lives easier, because they speak the M&A language. So I've always believed in hiring the best advisors you can afford. Everyone's at different stratospheres in their business budgets. Now we've grown really big. So like Latham Watkins is one of our law firms. They're not cheap, but they do really good work. And when you need something, they can deliver. And when you grow to our size, speed really matters in transactions. And, these guys can basically work around the clock, and it's money well spent.
And I've come full circle on this. At first, I thought that you should try to beat up your investment bankers and get a lower price, or maybe you go with the tier B team. But I've fully realized now that actually, and this is my friend Brian's theory, that if you see a high fee or higher fee, you should probably actually go with whoever that is, because it means there's some sort of incremental value there, which is counterintuitive to how we think about negotiating for deals, but you actually get more. Like, let's say it's 1%, you have to pay 1% more. Are they going to actually help you get 1% more value? Probably.
Yeah. If you get 99% and they get to keep 1, that's a lot of incremental value. You always have to flush it out, right? You always have to put them to the test, etc. But you're exactly right. The analogy I always use is, do you want the lowest cost heart surgeon? Right? Nobody wants the lowest cost of heart surgeon, right? So I know this isn't heart surgery, but you're exactly right. Sometimes there's incremental value. And a lot of times it comes in experience, having done this before, knowing shortcuts, knowing pitfalls. That's where they might have that incremental experience versus, that other firm. Maybe they're a generalist, they don't have as much experience. They don't have as many tombstones. And, that's that. You're right. You're going to pay for that service. And, generally that's going to be money well spent when you're keeping 99 cents of the outcome.
Totally. Philip, you came from the commercial banking world, and then on day one, COVID hit. And if I got my research right, you did set up a facility with a bank to have there just in case. I'm curious if you have any pointers for CFOs who need to get a loan in a pinch.
Again, being a banker, the time to get a loan is not when you're in a pinch. Interestingly enough, we did have credit facilities in place prior to COVID. And so we were able to lean into those. We did qualify for PPP financing. And I mean, that's precisely why that program happened, because it was so wildly successful. I mean, we went back to our partners and talked. We actually had a minority debt investor, a sub debt investor in the deal when I took over as CFO. We went back to everyone during COVID, and they were all kind of, remember, this was like right at the very beginning of COVID. They were kind of like, we're all pretty nervous right now. Let's kind of see where things land. Right. And so, the time to get a loan is when the sun is shining and things are good, because, that's when the banks are going to be most aggressive. That's when you put a bid package together and you're going to get competition, and that competition is going to drive a market price. When you're in a pinch, they know it. And so the pricing and the structure is going to reflect that. And, my biggest tip relative to banking partners is have great relationships with your banks. When it comes time to put the deal out, you got to bid it out. You got to get the best deal. You're a fiduciary of the company. But once the business is closed, then you have to be in the business of building the relationship. You need to shower those banks with cross-sell revenue and incremental, the guys that lend you the money, when you need them, you need them. So move your credit card business over to the bank, because in a pinch, having worked on that side of the fence for many years, that's what those guys are looking at. They're looking at incremental wallet share. And if they have a big wallet share like our lead banks do, they're going to help you during those softer times, because they know if you're a good business, you'll come out the other side, and they want to retain all that cross sell. If you're just you're just in there for the checking account and the loan, and things get tight, I don't think you're going to get as much leeway.
Yeah, I love how you pointed that out, because as a CFO, you have different chips on the table, right, that you can offer them. And like you said, shower them with the chips that, you need to do that. It's just table stakes for your business to run anyway.
You got to do it anyway. Like our one of our banks has all of our insurance business because they have a big insurance agency. I got to buy insurance from somebody.
I need insurance,
right?
Yeah.
Right? I got to have it. So I might as well buy it from one of my banking partners, who also happens that we have a $300 million plus facility. Like, these guys lend us a lot of money. So let's take care of them where we can. And that's been a big part of, building our banking relationships here at West Shore. JP Morgan and Huntington Bank are kind of our two, kind of our lead and joint lead arrangers. And we've had a multi-year partnership with them, and we do a lot of business together with those two firms because they have been big supporters of our company.
That's great. Philip, I'm going to take you into what we call our long ass lightning round. So you're a successful guy, but I ask everybody, what's an example of something that you've screwed up on the job? It could be this job or a different one.
Something I've screwed up on the job. Oh, geez. Look, when I joined this company, we were a little over 100 million in sales. We'll probably be a little shy of $1 billion this year, probably in that, 850, 900. So there was a lot of mistakes made on the way over the past 3 or 4 years. Nothing really sticks out, but what I can tell you is there's lots of small mistakes. The biggest thing when I make a mistake is I own it. That's one of the core values of our company, extreme ownership, right? So you even have to think about things that maybe aren't fully your responsibility, but you played a role, and it's about blameless problem solving. Let's all take extreme ownership of the problems. Let's not point the fingers at and say, well, that's so-and-so's problem. Look, if we're gonna revolutionize an industry, we need extreme ownership. And then don't make the same mistake twice, right? That's kind of why I don't think anything really sticks out. I've misread contracts, or, I thought it said one thing and it said another. And then when push came to shove, it was like, why did I agree to that? We all make mistakes. Our owner, though, and founder, he's really good about that. He's like, look, Phil, we're going to break stuff on the way to greatness. And there's nothing wrong with that. It's how you react to it, how you own it, how you fix it, and how you move forward from it versus making the mistake. So I make plenty of mistakes, and I've worked here a lot of years. He's never called me out once on it because I know I'm going to do exactly what I just said I was going to do.
Love it. If you could tell your younger self something knowing what you know today, what would you tell him?
So I started my career in commercial banking, and I loved it. And it taught me so much. So would highly recommend it. But if I had to do it all over again, I'd probably start in the capital markets or the investment banking side of the business versus the traditional corporate bank. I've gotten to work there more so as a client. Obviously, I did a little of that stuff. The banks I worked for had some M&A shops, and we had debt capital markets, smaller equity capital markets. They weren't big equity banks, but I really enjoy that part of the business. And then look, the reason I think I'm here today and what I've grown into is not because I'm the smartest guy in the room. It's because two things. The devil's in the details. I'm a big details guy. You need data. When you speak about something, make sure that you have the data to back it. And there just can't be a replacement for hard work. I always say good luck is where hard work meets opportunity. I mean, that's what good luck is. You make your own good luck. And I've always ascribe to that. Obviously, when you're living in the moment, it doesn't always feel that way. But when you turn around and look back, you can see 9 out of 10 times that's exactly what happened.
That's cool. Can you walk me through your finance software stack? What tools do you use to get the job done today?
So we've got a couple. Obviously, we have an ERP, which we are, like most companies, looking at upgrading that. It got us to, it was a financial force, and I believe they rebranded it Certinia. They sold it off. And so that package, got us to where we're at today. But we are in the process of, it's one of my second half of the year goals is to actually physically select a vendor and sign the contract so we can begin the implementation in 2025. We use Blackline for closing the books.
Nice.
That's been a really, really great product for us. Nothing but good things to say about my experience with that. We use NetSuite's budget planning tool for our FP&A. And same thing, that's been really good. And then from an AP automation, we use Medius. Again, we really, really enjoyed our partnership with Medius. That product works very well for us. And then Concur for expense management, card controls. I would say that that makes up the majority of the finance stack.
A lot of familiar names in there. Nice. I'm sure you'll now have about 100 BDRs from ERPs reaching out to you after this podcast.
Yeah, we've narrowed it down to like 3 or 4. We've hired a search.
Still gonna email you.
Yep, they'll still email me though. I get it.
Last question I got for you. What's the craziest thing you've ever had someone try to expense?
Nothing too crazy. It's the one that comes to mind is the more common ones are gym memberships and Netflix.
Netflix?
Yeah,
we haven't had that one. 85 episodes.
It's there's been a lot. Like, so we didn't have Concur when I got here. So
yeah,
we built, we've really built just like the front of the office, the back of the office has really been building and evolving. I mean, frankly, I was the first finance employee in the sense that we had an accounting staff when I started here, but it was all accounting. There was no budget planning. There was no consumer finance department. There was no, really leasing for our vehicles. Kind of, we have a group now that manages all of our leases, both for our trucks as well as our real estate. So we had to build all that stuff from scratch. And so we, of course, had to build the systems to go along with it. And we went on that journey of developing a PCAOB audit And so that required us to, increase our financial systems to make for the quick closes and the better reporting for KPMG. And then lastly, really just growing kind of all of the financial systems to support. We're up over 3,000 employees now. So, we needed systems that scale.
That's awesome. Philip, this has been a pleasure. I love diving into your industry, and congrats on all the success. It's crazy how much you've scaled the business in less than 5 years.
Yeah, no, I really enjoyed it today, CJ, and I think there's still plenty more ahead for our industry. Just a couple of quick stats in closing. So as we enter 2025, 90% of homes in the United States will be over 20 years old. And there's a lot of houses turning 20 years old because, as we recall, there was a huge housing expansion in 2005 and 2006. So really, really good trends there. Another really interesting trend, and you kind of hit on this with younger homeowners, more millennials are entering the home market. And B of A recently did a survey, and over 80% of the millennials they surveyed say they want to buy an older home, which is going to be more affordable, and renovate it rather than buy. And then you kind of fell right in this category. And then they're focused on doing remodeling projects in the first year to upgrade it. So, I think that's another great trend for us. And lastly, aging in place. This is probably the most staggering statistic. By 2030, 132 million people will be over the age of 50 in the United States. That's 40% of America's population.
I was going to say, it's got to be over a third, right?
Yep, is going to be over 50. And obviously, once you get to 50, you start thinking about, hey, how do we modify our home? How do we change things up, especially when we're in our earning years where we're still bringing in like really good incomes? If we want to stay in this house, what changes do we need to make? So you got millennials entering the market at one of the largest populations ever, jumping into the home market. You got aging in place where, especially going through COVID, people don't want to move into that retirement home or nursing home. They want to stay in their existing homes and fix them up. And then you've got a big backdrop. So hopefully, if we can expand the overall TAM, there'll be plenty to go around. But really enjoyed the conversation today, and thanks for having me.
I'm hyped. I'm gonna go upgrade my shower after this.
Thanks, CJ. Have a great afternoon. Bye bye.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.